when markets are volatile, Katie, and you know this, that like when stocks are the main headline mover and that's the fearful piece, that's the volatile piece, commodities and interest rates and everything else tend to pick up in volatility as well. The last couple of weeks here, it's been crude oil. That's the headline mover. That's the really volatile piece. But you see stocks and interest rates and other commodities like gold and everything else start to pick up in volatility and that creates the question of, how am I picking where to go? Maybe, of course, I would advocate for diversification's sake, trying to sprinkle in everything, but where do I start and what can kind of signify to me what the opportunity is? And, you as someone who has a grasp of every asset class in futures, what, when you open your platform, kind of are you looking for to pique your interest as a first place to go?
That's a great question. Lately, I mean, it kind of all depends on like what's been moving, right? But as you said, of course, all of the major headlines have said equities, this, crude oil, that, metals and interest rates, tertiary, I guess, is kind of what I've seen and observed mostly. So that's where I've been kind of looking when I am on my way into work, or like when I wake up in the morning and I'm checking my phone to kind of see where we are on the day. But that doesn't discount the fact that like right now, I just joined you in that small dollar trade, but I also have currency positions on. So I'm also actively looking at my existing positions and then seeing, okay, I've already got exposure to tech with, Netflix or Spotify or whatever. Where else can I start to pivot? Because like you said, diversification is kind of the name of the game here, spreading things out so that we're not just overexposed to one general area.
100%. And that is the nice, like at the end of the day, you hope that like if 4 out of 5 major asset classes are outside, that you get a little piece of all of them. Because we always advocate for diversification. You don't want to see like, oh, crude oil, that's the headline everyone's talking about. I'm going to dump 100% of my account into a long or short trade there. You want to sprinkle it throughout all of these different diversified markets in here. But this has been the case for the last couple of weeks here, Katie, where you've got 4 out of the 5 asset classes here being stick. That's your tech stocks. So essentially equities, SMO, that's your small crude oil, SPRE, that's your gold and silver market in there, S10Y, that's your 10-year interest rate market, and SFX being the US dollar, that's your foreign exchange market. So we've got 5 major asset classes, and almost 4 days out of 5, you're seeing every one of these asset classes outside of its daily range. Yesterday, I just took a quick screenshot of the market and saw that tech stocks, crude, metals, and interest rates, not US dollars yesterday, were all outside of their daily range. So then the question becomes, okay, I want all of them, sure, but where do I start? And also what might pose the best opportunity technically? And do you know this better than anyone, that volatility or outliers are often synonymous with opportunity. And that's a good place to start with the maybe not the best, the most profitable trade, but the best place to start, or the place showing the greatest potential, is the biggest outlier, right?
Yeah, exactly. So it's kind of like a balance. So, right. Like you said, crude oil, we see this like once every 5 to 10 years. So obviously that's kind of on the very extremes of the 5 of the 6 that we just like listed there. Right. But then there's other ones that kind of will also be on that spectrum somewhere. And maybe then that's when you take into account other elements like your account size, or if you already have an existing position in some of these things. But yeah, general rule of thumb, the larger the outlier, the more potential for opportunity.
And this is where implied volatility for options traders and standard deviations for futures traders are the great equalizer, right? Because, a $2 move in crude is a pretty good move. A $2 move in our interest rate product or our US dollar product, that's a huge move. And so you can't necessarily go apples to apples and be like, oh, well, all things equal, I'm just looking for anything that's outside of $1 move in any of these markets. $1 in crude means a lot less than $1 in interest rates or foreign exchange. standard deviations equalize all of that. And so you can look in there and say one standard deviation in crude is $2. One standard deviation in interest rates right now is 50 cents. And thus the market that's showing the biggest multi-standard deviation move there, that's going to be the most opportunistic market to me. So with that example in mind, crude, one standard deviation, $2. S10Y, the 10-year interest rate, it's 50 cents. If S10Y is up or down $1.25, that's more than 2 standard deviations. And crude is up or down $3, that's only 1.5 standard deviations. Interest rates probably pose the greater opportunity. I mean, that's at least the way that I think. What about you?
No, I completely agree. And I mean, again, it goes back to like, I know I'm getting ahead of myself because of course I saw the slides here. But it goes into like those extra decision-making pieces, right? Where with crude oil, what's the buying power in SMO right now? Like $2,000-ish, more or less?
It's they're definitely moving it up to $2,000 on account of that market is like doubled in notional size and is moving way more than it used to, for sure.
Yeah. So, I mean, that's kind of the next piece of this is if you're being forced to choose between two, maybe you go to the one that is the better use of your capital. If you're in a small account, again, $2,000 in crude oil versus maybe $400 in S10Y. So it's all just kind of a delicate balance, I guess, is the way that I would describe it. But, if you're in a Sosnoff sized account, go hard, do what you want to do.
Yeah. If you're in that position, if you're thankful enough to be in that position, you could just, do everything, which is what he does. But you raise a great point, which is like the dollar move. I think a lot of people see like, oh, this thing is up $5,000. And so that's the greatest opportunity. Well, if it tends to move, $3,000 or $4,000 a day, it's not the greatest opportunity for you. The thing that's showing the biggest outlier, that's the biggest move relative to what it normally does, that's where the opportunity is. And also that pairs well with your idea of like, don't jump on something that is too big for you. If the opportunity is in crude and you're not comfortable with 300, 400, I mean, today, even in our small product, more than $1,000 move, then that's not for you. Move on to something else. There'll always be something else there. So make sure you get something that's showing a good opportunity, but also not too big of a risk notionally. And there's almost always going to be something that is outside of one standard deviation or even two that combines that volatility, that opportunity, and movement that fits your account. I mean, you look at this S10Y, and the biggest moves that we've seen in the last several months are $100 to $150 notionally. That can fit most people, right?
Yeah, exactly. And I think this is like a really good point that's not really talked about explicitly. And that's when we see markets start to move and get more volatile, it's so tempting to throw your mechanics and your typical P&L targets out the window because you're seeing such great opportunity somewhere. But you've got to keep that in check because, of course, like everybody loves the story of when they bought crude at $0 and now look at it at $120 a barrel. And like, it's like this not instant gratification thing, but like if I would have just been long for a year, look at what would have happened to me. But you need to still like stay in your own world, if that makes any sense. Like you're saying here, find that combination of volatility and size and don't expand your profit and loss targets too much beyond to make sure that you're able to stay in the game, I guess.
100%. A good place to start with me is always like entering at one standard deviation and looking to manage around half of that standard deviation. So here it's down 50 cents. I'm looking at buying, up 50 cents. I'm looking at selling, and I'm looking to make 25 cents here. And you make a great point. You need to adjust in high volatility, Katie, but not throw the stuff out the window. So this market with volatility entering all asset classes, I might say, all right, instead of entering at 50 cents, I'm entering at 70 cents or 80 cents, and I'm looking for 30 or 40 cents at management, but not throwing everything out the window.